Chapter 7 deals with what's called differential analysis. It says it's the key to decision making. And what we're really going to talk about is we're going to talk about how you make business decisions. In other words, we've accumulated all this cost information and we've developed an understanding of how our customers' costs behave, about variable costs and fixed costs, product costs, period costs, direct materials, direct labor, overhead, activity-based costing and cost drivers and all of this. And now what we're going to talk about is how we use this to make business decisions. And so if you're watching this video and you're taking a managerial accounting class, you've probably been saying to yourself, I'm not going to be an accountant, so I don't need to know all of this. But reality is that you're going to be using accounting information because you're going to be making exactly the kinds of decisions that we're going to be talking about in this chapter. So the reason why it's important to understand fixed versus variable cost, activity-based costing, product versus period cost, is not so that you can prepare managerial accounting reports, but it's rather so that you can use those reports and you can use this information to make decisions for your business, whether you're a manager in the business, whether you are a business owner or anything like this. So everything that we're talking about here is very, very relevant to day-to-day management decision-making in all different areas of business, not just in management per se, but also in marketing and a lot of the other, what we call disciplines in business. So a key piece of information here is to understand the difference between relevant and irrelevant costs and benefits in a decision. And basically, a relevant cost is a cost that's going to be different between alternatives. An irrelevant benefit is a benefit that's going to be different between alternatives. And so when we make a decision, we're only going to focus on costs and benefits that are relevant. Now, I know that sounds very obvious, but when we get into the nitty-gritty of this, you're going to see that it's not really so obvious what's relevant and what's irrelevant. So when we're talking about costs, we want to focus on the avoidable cost, a cost that can be eliminated in whole or in part by choosing one alternative or another over another. And avoidable costs are relevant and unavoidable costs are irrelevant. Because sometimes when you're making a decision, part of what's involved is a certain cost that's just not going to go away. So that's not an avoidable cost, and therefore it's something that should be ignored. You only want to focus on the costs and the benefits that are going to change. And there are two categories of costs here that are never relevant in any decision at all. And they would be what's called sunk costs and a future cost that does not differ between alternatives. And again, this sounds very obvious, but when you see it in actual problems, you'll begin to see it in action and you'll better understand what I'm talking about. When I'm talking about sunk costs, I'm talking about something you spent money on that you can't change. You already spent the money. So suppose for a moment that you're making a decision about whether you should make a major repair to your automobile or not. And the car's not worth very much money, and the repair is going to cost, let's say, $2,000. And you're trying to decide, should I make this $2,000 repair? The $2,000 is relevant because that's how much you would have to pay. But something which might enter into your decision is the fact that you just bought new tires for the car. I just spent $500 on tires for this car, and I don't want to lose that. Well, you know what? It's gone. It's we call a sunk cost. You already spent the $500, and you're not getting that $500 back. Whether you fix the car or you don't fix the car, the $500 for the new tires that you just installed a week ago is gone. And that's what we call a sunk cost. It's not relevant to your decision at all. What's relevant is the $2,000 that you would need to pay. Another thing that might confuse you in this process is, let's say that a future cost that does not differ between the alternatives. You know you're going to have to pay more money later on for something else. And that doesn't matter one way or the other, because the main decision that you have to focus on is where the costs are going to be different, not where they're going to be the same. And oftentimes what happens is that there's a psychological effect where people don't want to lose. It's called it's called framing. And when you frame it that I lose $500 because that I spent on these new tires, that there's actually a psychological effect that makes you not want to lose that $500, and that affects your decision. But mathematically, it doesn't affect your decision because you spent $500, the money's gone, and whether you're gonna fix the car now for $2,000 or not, that's really what's important. So the first thing that you would do is you would eliminate all the costs and benefits that don't differ between the alternatives. Go through them one by one and say, would I have to pay this either way, or would I receive the money either way? If it's the same under both alternatives, you completely ignore it. And then you focus on the costs and benefits that are going to differ between the alternatives. And these are what we call differential or avoidable costs. And remember that every situation is different. So costs that are relevant in one decision situation may not be relevant in another. So in each situation, you have to look at the data very carefully and isolate the relevant costs. In case you're not familiar with my videos, these are all from the book. So you could take any one of these videos, you look them right up in the book, Noreen Brewer Garrison, Managerial Accounting for Managers, the 4th edition of the book, and they're all right there. So if you don't understand something from the video, you can open up the book. I also have a link to a handout, looks like this week. There you go, a link to a handout. You can print that out if you want. And it has exactly what I have here in Excel and in a PDF format, so you can print that out and you can look at it along with me. Anyway, so not very creative. Accountant, I'm an accountant, so I'm not too creative. Anyway, Cynthia's in Boston and she wants to go to New York City, and should she drive or take the train? And it's 230 miles, and she's going for 2 days. So these are some of the things that are relevant or not relevant. This is some information about, let's use that word, some information about the decision, and let's pick through this and figure out what she should do. So it's a 230 mile trip each way. I believe, yeah, it's each way. And the trip itself is 2 days. She's gone for 2 days. So she has a car, and she figured out that the annual depreciation on the car is $2,800. So figuring it that she's doing 10,000, she does 10,000 miles a year, that would be 0.28 miles. Gasoline right now is $3.30 a gallon, and the car gets 33 miles per gallon. So we figure gasoline is about 10 cents a mile. Auto insurance costs $13.80 a year. She obviously doesn't live in New Jersey. And license is $13.80 a year. So per mile for 10,000 miles a year, that's 13.8 cents miles a year. Maintenance and repairs. Cars, the longer you drive them, the more they break. So maintenance and repairs typically cost 6.5 cents a mile on average. And also, when she parks at school, she pays $45 a month, and she's at school for 8 months. It's actually, I think that's probably about the same as Seton Hall. So it's $360 a year for parking. So per mile, that's 3.6 cents per mile. So she figures that the average cost per mile during the year, if she drives 10,000 miles, it comes to about 61.9 cents per mile. Now, there's a few other pieces of information here. The more she drives the car, the less it's worth. And she's figured out, I guess she's an accounting student, that the reduction in resale values approximately 2.6 cents per mile. I'll just tell you that sounds a lot like depreciation to me. But anyway, depreciation is different, right? Depreciation is the allocation of the cost to the years benefited from using the item. Now, if she takes the train, it's $104 round trip, and that seems pretty high. Relaxing during the train ride, it's a lot more relaxing to just sit on the train and chill, and then to drive on I-95, especially, the I-95 corridor between Boston and New York City. There's a lot of traffic there. It's much nicer to just recline your seat and put on your headphones and just fall asleep. She's got a dog, so when she goes on this trip, she's got to put the dog in a kennel, and they're going to charge $40 for that. If she has the car in New York City, that means she can drive around rather than walk. Sometimes they're long walks. But if you're in New York City, you have to park, and parking is a pain in the neck. And if you want to park in a garage, which I guess she wants to do overnight, that's going to be $25 a day. So what we're going to do here is we're going to focus on what's relevant and try to ignore what's not relevant. So let's go through it one by one here. Annual straight line depreciation, not relevant, because it's not going to change. She has a car and it costs a certain amount of money. The car depreciates, I guess. Gasoline is relevant because the more you drive, the more gasoline you use. And if she drives to New York, she's going to use more gasoline than if she doesn't drive to New York. Auto insurance and license is not relevant because she still has to pay it. It's fixed. Maintenance and repairs is relevant because if she drives the car further, then it's going to need more maintenance. Parking fees at the school, is that relevant? It's not, because it's going to be the same either way. You have to pay $360 a year at school for parking, no matter what you do. So you might say, I pay all this money for parking at school, either I might as well leave it at school because I'm paying for the parking, or you might say, I'm paying so much money to have a car at school, I might as well use the car and go down to New York City. And in fact, that would not be correct because you still have to pay it either way. Reduction in resale value due to wear and tear, that's relevant because the more you drive the car, the less it's worth. So the value of the car will go down. The cost of the train ticket, if I take the train, I'm going to have to pay it. If I don't take the train, I'm not going to have to pay it. Now, the benefit of relaxing, I can assign a number to that or I can ignore it. Putting the dog in a kennel during the trip, that's not relevant because whether I take the train or I walk, or, well, you're not going to walk, or I drive, you still have to put the dog in the kennel. Benefit having the car available in New York City, priceless. No, you don't know how much that is. If you want, you can assign a value to it. And likewise, the hassle of parking in New York City, it's a big pain in the neck. And if when you find a parking space, right, it feels really good. That also that's not relevant because you can't assign a number to it. Maybe you can. Cost of parking the car in New York City is relevant because if you take the train, then you don't have to park the car. So let's list the relevant costs of driving to New York City. What are the costs I'm going to have to pay if I drive to New York City? One of them we said is going to be gasoline. It's going to be 0.100 a mile times 230 miles times round trip of 2 is going to be $46. Another thing that's relevant is maintenance and repairs. That would be 0.065 times 230 times 2 for round trip. What else do we have? Reduction in resale value. Reduction in resale value would be 0.026 per mile times 230 miles times 2 days, or $11.96. And finally, I would have to pay parking in New York City. and I would have to pay for $2, $25 for 2 days. So that would be $50. So the total relevant cost of doing this in New York City, of driving, would be $137.86. Now, how about taking the train? I only see one. I've got all these items. The only thing I see is the round trip train ticket. And that's going to be $104. So now I've broken this down into a very simple question. The differential cost is $137.86 minus 104, or $33.86. That is the differential cost. So is it worth to saving $33.86 to take the train? And I would benefit, then consider the qualitative factors for a moment. I would benefit from relaxing, but I wouldn't have the car available, but I wouldn't have to try to park the car. So all these things are relevant, and that would be it. Now let's do more of a business problem. Should the company rent a new machine for $3,000 a year? And I'm leaving out a lot of the details. If you want to read the details and all entertaining names and things that the book comes up with, then you can read the book. You should read the book anyway. So right now, we make 5,000 units. The selling price per unit is $40. Direct material per unit is $14. Direct labor per unit, $8. Variable overhead cost per unit is $2. Fixed expenses is $62,000. And if we rent the new machine, we're going to have to pay an additional $3,000. Now, if we use the new machine, instead of paying $8 direct labor per unit, I'm only going to have to pay $5 because the new machine's much more efficient, it's more automated, and there's less direct labor needed. So I would pay $3,000, but my direct labor would go down by $3 a unit. So you could do this the long way. Like so. You would do sales 5,000 times 40, or 200,000. Then my variable expenses would be direct materials 14 times 5,000. Direct labor would be 8 times 5,000. And variable overhead would be 2 times 5,000. So the total variable expenses would be $120,000. And I'll calculate the same thing for the new machine. Right there, you can see variable expenses is going down. My contribution margin would be equal to sales minus variable expenses or $80,000 for right now. Under the new machine, it would go down to $95,000. My current fixed expenses either way is $62,000. There we go. We have some. I'm going to give you commas here in a moment. But only onto the new machine would I have to pay this additional rental. So my total fixed expenses would be $65,000 for the new machine, but only $62,000 for the old machine. So my operating income right now would be $18,000. With the new machine, it would be $30,000. And that's formatted a little nicer now. So, but we could just focus on the differential here, and you can see that we would have a decrease in direct labor of $15,000, but an increase in the rental of the new machine. So if we look at it that way, we would have a decrease in expenses. I should really do this in the other direction because there would be an increase in income. I would have an increase in income or a decrease in expenses of $12,000, which is just the difference between these two. Now, that's a lot of work. If you want, you could just focus on the differences, and that's, you can call this a shortcut, or you can call it, I don't know. It requires a little more thought, but the decrease in direct labor cost is just 5,000 times 8 minus 5. Let me put that in parentheses. So that would be, the decrease in direct labor would be $15,000. So I'm going to put that in as a positive because it would increase the income. And then have an increase in fixed expenses for rental. That would be $3,000. And therefore, the net increase in the net cost savings from acquiring and using the new machine would be $12,000, like so. So you can do this the long way if you want. I happen to like the long way because I like going through all the calculations, but you can also do it the short way and just focus on what's going to be different, i.e. the relevant costs. And just one more thing. If you use this differential approach, that's the shortcut, you got to keep in mind that oftentimes that's all you're going to have enough information for. In other words, you might not have enough information to go through and do it the long way. You might not have all this information. You might only have enough information to focus on the differential and use the shortcut anyway. And you have to be very careful not to mingle irrelevant costs with relevant costs, to distinguish what's relevant and what's irrelevant, because it's very easy for people to get confused. There's all sorts of psychological tricks that people play in their heads, and that completely messes up the calculation. Learning objective 2 deals with whether or not you should keep a product line or not. So, or a segment. And this is a huge decision for a lot of companies. Should we sell this product or should we not sell this product? And what you might want to do is you might want to drop an old product for a new product. And this is especially important when you have segments and you have all kinds of operations that revolve around individual segments. And so again, you have to focus on the relevant costs and ignore the unavoidable costs. So let's try one out. For this problem, I'm just going to walk you through the example, and I'm not actually going to do it for you because there's just a lot of number work here, and hopefully it's common sense. So this particular company has 3 products. It's called Discount Drug. It has 3 product lines. It has drugs, cosmetics, and housewares. So as you can see, drugs has a contribution margin of $75,000 and income of $16,000. Cosmetics has contribution margin of $50,000, net operating income of $12,000. Housewares has contribution margin of $20,000 and net operating income, a loss actually of $8,000. So the question is, if they're losing money in housewares, should they keep this line or should they drop it? So what we need to do is we need to go through all of these expenses very carefully and determine which expenses are avoidable and which ones are not avoidable. So this is the fixed expense section, and we would assume that all the variable expenses are avoidable because they vary with the volume. So we're going to focus just on the fixed expenses. And I've taken these numbers, I haven't, the book has, taken these numbers and breaking them down into avoidable versus not avoidable. So with salaries, if I cancel the housewares line, then I'm going to have fewer hours to pay employees. My employees, let's say, are all hourly, and so I'll save money. The same thing with advertising. If I don't have to sell housewares, then I don't have to spend money advertising housewares, and I'm going to save that cost. Utilities is not avoidable because I'm in a certain location and I pay certain utilities. And even if I stop selling housewares, I'm still going to need the same amount of heat and electricity in order to run my store. So utilities is going to stay the same. Same thing with depreciation fixtures. Those are what we call a sunk cost. I paid for them and now I have them and they're going to continue to depreciate. I'm not going to throw them away. I'm going to use them just for other things. Same thing for rent. I pay a certain amount of rent, and even if I stop selling housewares, I'm going to have to pay that rent. Insurance, if I reduce my product line, I'm going to save $500. I'm going to not have to pay that insurance. And I'm going to save the general administrative. Let's say I have some kind of manager in the store who's in charge of housewares. I'm not going to have to pay that person to do it anymore, and so I'm going to save $6,000. So, of the $28,000 in fixed expenses, $13,000 is not avoidable, and $15,000 is avoidable. So, we can do a very quick summary here of what's going on, and we don't have to do a whole income statement, although you can if you want. You can redo this. You can say this is what we're doing now, and if I drop housewares, remove all the avoidable costs here and remove the sales and variable expense and contribution margin, and then see what would happen and see if it's any different. But there's a much easier way to do it. I would lose all the contribution margin. Right now I'm receiving $20,000 in contribution margin. If I drop housewares, I'm not going to get any contribution margin from the housewares, and therefore I'm going to lose that $20,000 in contribution margin. On the other hand, I'm going to save $15,000 in avoidable costs. So that would raise my income. And the way I like to do this, I like to be very, very consistent, is how everything's going to impact income. And it's easy to make that mistake. I'm going to reduce expenses, so it's going to increase income. That's it. Don't reduce expenses and subtract it, because you're reducing expenses. Focus on income. What effect is this going to have on income? If it's going to increase income, it's positive. If it's going to decrease income, it's going to be negative. So if I'm going to lose $20,000 in contribution margin, that's going to reduce income. It's going to decrease my income, so I'm going to subtract it. If I'm going to save $15,000 in fixed expenses, that's going to increase my income because it's $15,000 worth of expenses. I'm not going to have to pay. It comes right from there. So I'm going to add that. And I wind up with a net decrease of $5,000. Meaning that if I were to stop selling housewares, then my net income would go down by $5,000. And now that's a very simple answer that you can give to everybody when they say, okay, what would happen if we cut out housewares? Because they look at all the money that they're losing. You can say, if I cut out housewares, my income would go down by another $5,000. So right now I'm making $20,000. If I cut out housewares, I'm going to make $5,000 less, only $15,000. And that obviously is a bad thing. And therefore, as a result of this, we do not want, let me write it here, we do not want to drop the housewares line. We do not want to drop the housewares line. That is the answer to the question. You have to be very careful of allocated fixed costs. So, if you have some unavoidable common fixed costs, and we've talked about this before, they're going to make the product line look unprofitable. But if you drop the product line, those unavoidable common fixed costs are not going to go away. They're still going to be there, and you might wind up being even less profitable, and you don't want to do that. Another type of decision is what we call a make or buy analysis. And that would be, let's say there's a certain product that we sell. We could either make that product in our factory, or we could buy it from another factory, and we could have a factory make it for us. And there are a lot of reasons why you might want to do one or another, but it all comes down again to numbers. And when a company is involved, we talk about the value chain. The value chain is all the different things that a company does to add value. And there's the idea of, you probably remember this from economics and management strategy, of being vertically integrated. That would mean that how many steps along the value chain you have. For example, an oil and gas company, what's called an integrated oil and gas company, might produce its own oil and gas, ship it to the refinery, refine the oil and gas, ship it to a gas station, and market it to consumers. And those are all different steps in the value chain. Or it can just choose to focus on one step, such as producing oil out of a well and nothing else. And then they produce the oil out of the well, and then other companies do it. They sell it to other companies, and that's it. So how vertically integrated are you going to be? And that's a huge question for a lot of businesses. And there are some businesses that choose to own everything in the value chain. And there are other businesses that really do very little. I was reading about luxury watches, and very high-end watches, usually they do everything themselves. So for example, if you buy a Rolex manufactures all of the parts, makes the watches, and they have their own set of dealers. Now, they don't sell you the watch, but they have all the steps along the value chain created that they control completely. Whereas if you buy a very cheap watch, a fashion watch, let's say, like some kind of designer watch from the department store, the designer only designs the watch and maybe, markets it. And you have a factory in China that makes the watch and does all of the other things and ships it and does all these other things. And then the designer just sends, the designer basically just designed the face of the watch and the body of the watch and all those other things. So in a lot of businesses are like this, is how much you're going to do in your value chain, or how much you're going to have other companies do for you. This is a nice picture. If you're vertically integrated, then you have more control over all the pieces. So for example, a Rolex watch has control of the entire production process, because they do everything themselves, and they can control quality, and they can control all these other aspects of it. Whereas a cheap watch brand, I can't even think of the name of one, but let's say a cheap watch brand, like here, a good example would be something like a designer like Perry Ellis. And all they do is they just pay a factory to make the watches for them. They don't have very good quality control. And oftentimes the factory may be busy with other orders, so it's a little more difficult for them to make sure that the products are produced where and when they need them. So that is a problem with buying. There's a real problem with vertical integration also. And that is that if you do everything yourself, then you don't have much economies of scale. So if you have one company making watches for 20 different brands, then it's a huge factory, and they make all these watches, and they can do it very quickly and efficiently. Whereas if you have just one little factory where you make one brand of watches and very few of them, then you don't have good economies of scale, and it's going to get much more expensive. So mountain goat cycles. I don't know it's a strange name for a bicycle company. Would you buy a mountain goat cycle? Anyway, they make 8,000 bikes, and here's how much they need heavy duty gear shifters. And here's how much it costs them right now. Direct materials, direct labor, variable overhead, supervised salary, depreciation of the equipment, and allocated general overhead. Total cost is $21 a unit. And they make 8,000, so this is the total cost. And they're talking to a manufacturer who's willing to sell them heavy duty gear shifters for $19. So this looks pretty appealing because right now they cost $21 to make, and they could buy them from the outside for only $19 and save potentially $168 minus $152. They could save $16,000 doing that. So we could do a little analysis here. I happen to like showing it side by side. To me, it's always clearer this way. And I personally, when I do these exercises, I always try to do it this way. If I make the units, I'm going to have to pay direct materials. I'm going to have to pay direct labor, variable overhead. I'm going to have to pay the supervisor's salary. Am I going to have depreciation of special equipment? No. Because the equipment is there anyway. And you know what else is going to be there? Allocated general overhead. That's going to be there anyway. So this special equipment is still going to be, it's depreciation. It's there. So I paid for it. It's a sunk cost. And allocated general overhead is a common cost. So that's not going away either. So that's not relevant to this decision. And that's why I'm leaving it out. And in fact, what you could do is you can include it, but then you've got to include it under buy too. Because if you buy the goods, the equipment is still going to depreciate and the overhead is still going to need to be allocated someplace. We are going to have an additional cost here if we buy, and that's going to be the outside purchase price. The outside purchase price would be $152. So the total relevant cost here, and I'm leaving out the irrelevant costs. If you include the irrelevant costs, you got to include them on both sides. Making, the relevant cost of making is only $112, and the relevant cost of buying is going to be $152. So therefore, you would have a reduction in income of $40,000 if you buy. In other words, it's not a good deal. Now let's try something different. What if the company buys from the outside and then it uses that factory space to make a new product that's going to generate segment margin of $60,000 a year? So then we've got make or buy. And we've got the opportunity cost. Well, let's start off with total cost. We have total cost of $112. And in fact, what I'm doing here is I'm doing it like the book. If I was doing this, I might frame them as negative because they reduce income. But then I also have opportunity cost. You just have to be very careful to understand this. Don't do it in a mechanical way. If you understand this, it'll be much easier. Is that if I make it, I'm going to incur $60,000 in opportunity costs related to the new product that I can't make. So therefore, the relative cost, if you include these opportunity costs, is going to be $172,000 to make and $152,000 to buy. In which case, the choice is you would earn in addition, you would save $20,000 you would save $20,000 by buying instead of making. And let's just look at what an opportunity cost is. An opportunity cost is the benefit that you lose when you pursue a different course of action. So it's not actually cash outlays that are recorded as expenses, but this is money you lose. For example, suppose you're thinking about taking a summer class. And if you take a summer class, then you can't work over the summer. So there's two costs of the summer class. One is tuition, obviously, but the other is the income you would have made if you had that job over the summer. That would be a good example of an opportunity cost. Learning objective 4 is to prepare an analysis showing whether a special order should be accepted. So this would be a situation where you have a company doing its regular business, selling what it usually sells, and someone calls them on the phone and says, hey, we would like to buy a special order of a certain number of units. And this is not what you normally make. It's something extra. And so what you want to do is you want to isolate the costs of creating this special order and selling it to this particular customer. And so your normal costs aren't really going to change. It's just going to be the additional costs of this special order. And something else that could come up here are opportunity costs when a company has to make the company has the ability to has a certain capacity of, say, 100,000 units, and maybe they're at capacity and they can only make 100,000 units, and all of a sudden someone calls them and asks them to make an extra 10,000. So they have to consider how much extra it's going to cost to pay employees overtime to go over capacity, or if they're going to give up making other units in order to meet the special order. So this is a one-time order, and it's not your normal business. And what you really, again, want to focus on are relevant costs, and in this case, what I'll call incremental costs. Costs above and beyond what you would normally pay. Fixed costs here are usually not relevant because fixed costs are there anyway, and they're going to be there if you take the special order, they're going to be there if you don't take the special order. Man and Goat Cycles gets a phone call, Seattle Police Department, and they want to purchase 100 bikes with some special provisions to them because they're for the police department. I always thought police officers on bicycles, I don't know, I could take police officers on horses pretty seriously, but I don't know, there's just something about a police officer on a bike, because you think of bikes as being for kids. So when you see a police officer on a bike, you're kind of like, oh, nice bicycle you have there. And I don't know. Anyway, that's for another day. So Mountain Goat Cycles, and it tells me a Mountain Goat Cycle is kind of, anyway. The proposed sales price is $558, but the normal selling price, that's what the police department is willing to pay. The normal selling price is $698, so they want a discount. The normal cost for making this particular model is $372 for direct materials, $90 for direct labor, variable manufacturing overhead for $12, and fixed manufacturing overhead for $90. So the total product cost is $564, and normally you would say no because you have all that fixed manufacturing overhead and you can't even cover that for $558. They also want modifications. They want a nice little logo that says, police department, and it's going to cost $34 a unit for these modifications, and they need to design a graphic. It's going to cost $2,400 in total. So let's look at our costs here. The incremental revenue is going to be per unit $34, So for 100 bikes, it's going to be 34 times 100, or $3,400 total. And then we'll look at some incremental costs. So I'm going to start off with variable costs. And one variable cost is going to be direct materials. Of $372. Another is direct labor for $90. And another is variable manufacturing overhead for $12. And then I have this special mod. I think of that as the turbocharger. This bike is going to have a turbocharger. Because, you know, the police models always have like a little something, you know, so they're a little faster. Special mod is $34. Or they're streamers, right? So 372 times 100. 90 times 100. 34 times 12 times 100 and 34 times 100. So the total variable cost per unit is going to be 508, and the total cost for 100 bikes is going to be 10 times that, 50,000 times 800. So total variable costs. And then you have your contribution margin would be, oh look at this, I have the wrong incremental revenue. Why didn't you tell me? He probably driving $558. There you go. That makes a little more sense now. So 558 minus 508 is going to be $50 a unit. Or $5,000 total. And then the fixed cost is going to be $2,400. So then your incremental net operating income would be $5,000 minus $2,400, or $2,600. So this means that you would make an additional $2,600 if you chose the order, and since incremental net operating income you would take the order. Learning objective 5, determine the most profitable use of a constrained resource. So now we're talking about reality, because in reality you can't make as many of an item as you would like. You have a certain amount of capacity, and it would cost a lot of money to increase that capacity. And then you have to choose, and you have certain products you can make, and you need to figure out which product or which products, what mix of products perhaps, is going to maximize your profit. So this is called a constraint. A constraint is a situation where you can only make a certain amount of a unit. It's a bottleneck. And when there's a constraint, what you want to do is you want to select whichever projects or products are going to deliver the highest contribution margin per unit of the constrained resource. The wording here is very important. So again, you can think of the assembly line, and there's one machine in the assembly line that goes a little slower than all the other machines. And what you want to do is you want to keep that machine very, very busy and make as much contribution margin, squeeze as much contribution margin as you can out of that machine. and that's going to be our goal. So in these situations, fixed costs are usually not affected, and you're going to look for a product mix being how much of each of the different products you make, how much you're going to make of each product. That's going to maximize the amount of contribution margin that you're earning. And normally what we would do is we would look for those products that make the highest unit contribution margin in general. If someone customer is choosing between two different products, you're going to try to sell them the product that has the highest contribution margin per unit, the product they want, of course. And here what we're going to do is we're going to change that around a little bit, and instead of focusing on the highest contribution margin per unit, we're going to focus on the highest contribution margin in relation to the constrained resource, i.e. the highest contribution margin per unit of the constrained resource. So let me give you an example of how this works. We're making panniers. I never knew what a pannier is, and a pannier is apparently a saddlebag. Here's some examples. So you see like there's a bag on each side that you hang over the back of the bike, and then people buy these things. So I'm on my pannier template, and again, the highest contribution margin per unit of the constrained resource. And this plant is at capacity, and your constraint is some kind of stitching machine. And this stitching machine can do 2,000 minutes per month. So we have two models, the mountain pannier and the touring pannier. So the selling price of the mountain pannier is $25, variable cost is $10, and contribution margin per unit is $15. Contribution margin ratio is 60%. The touring pannier is $30 selling price minus 18 variable cost, giving you a contribution margin per unit of 12. So your contribution margin ratio there is 40%. So normally if you would generally want to sell mountain panniers because they give you more contribution margin per unit. Not here. Mountain pannier takes 2 minutes in the stitching machine per unit. A touring pannier unit takes only 1 minute in the stitching machine. And the demand for the mountain pannier is 4,000 units. Demand for touring pannier is 7,000 minutes. If you didn't have any constraint, then you would want to sell each one at demand. 4,000 mountain panniers and 7,000 touring panniers. The problem is that if you do that, then you would need 7,000 minutes in the stitching machine for the touring pannier, but you would need 8,000 minutes in the machine for the mountain pannier. That adds up to 15,000 minutes, but you only have 12,000 minutes available in this machine. So you can't make all of the items that your customers demand because you only have 12,000 minutes in this machine, and you would need 15,000 minutes in the machine in order to make these units. So compute the contribution margin per unit of constrained resource. Mountain pannier makes $15 a unit, and the touring pannier makes $12. But the stitching machine needed for the mountain pannier is 2 minutes, and it's 1 minute for the touring pannier. So the contribution margin per minute of the machine, mountain pannier can give you $7.50 per minute, whereas the touring pannier can give you $12 of contribution margin per unit. So what you're going to want to do is you're going to prefer the touring pannier because it produces more contribution margin per unit of the constrained resource, in this case per minute of stitching time. So if you do a little calculation here, you can see that the mountain pannier produces $15 contribution margin per unit. Touring pannier produces $12 contribution margin per minute. And in 1 hour, if it takes 2 minutes of stitching time for the mountain pannier, that means that you can make 30 units in 1 hour. So 1 hour in the stitching machine is going to give you $450 if you're using the mountain pannier. Now the touring pannier only takes 1 minute per unit, so you can make 60 units in an hour, and therefore using the stitching machine for an hour you can earn $720 worth of contribution margin. So clearly the item that you're going to prefer will be the touring pannier, because you can squeeze a lot more out of 1 hour than the touring pannier, because the touring pannier is going to give you a lot more profit per hour of stitching time than the mountain pannier. The problem is that you only demand 7,000 units of it. So under this constraint, how much can you produce? The total minutes of constraint available per month, we said, is 12,000 minutes. So I'm going to start off making all the touring panniers I can. And there's demand for 7,000 touring panniers. And each one only takes 1 minute out of the stitching machine. So therefore, the total minutes needed would be 7,000 times 1. That would use up 7,000 of my minutes in this machine. That leaves me, so I make all the units that I can possibly sell, 7,000. It takes up 7,000 minutes, and that leaves me with 5,000 minutes. Now I'm going to use that to make mountain panniers. So the mountain panniers take 2 minutes per unit, and let's put that here. Take 2 minutes per unit. I've got 5,000 minutes left, so that would mean that I can make 2,500 mountain panniers. And that's how I would maximize my production, is with 7,000, wait, I should highlight this, 7,000 units of touring panniers and 2,500 units of mountain panniers. Now, what would happen if I can get more of that constrained resource? If I can get more minutes on that pannier machine, what should I do with that resource? And obviously, that's where the problem is, and it should be a key management goal to increase that constraint so you can make more money, because that's what's limiting how much money you can make. We can only make as much money as we can squeeze through that stitching machine. So naturally, you want to break that constraint and make more so that you can earn more money. And what's interesting about this is how practical it is, because this is a problem that you're going to have all the time. Everything in life has constraints. And the battle in business, looked at from this perspective, is to increase the constraint so that you can produce more and make more money, obviously. So increasing capacity should allow you to increase your production and therefore increase your sale. So what you're going to do is you're going to multiply the contribution margin per unit of the constrained resource by whatever the amount of additional capacity is. And as long as you have the demand to do that, then that's going to be additional profit. So how much additional profit can be earned if you can squeeze out 1 more hour of machine time? So for the mountain pannier, the contribution margin per constrained resource we said was $7.50, and for the touring pannier it was $12. So if you had 1 additional hour of the mountain pannier or 1 additional hour of the touring pannier, using that for the mountain pannier would deliver another $450 in profit. For the touring pannier, would deliver another $720 in profit. So naturally, if you were able to get another hour on that machine, you would want to use it for the touring pannier as long as you have the demand. So this is a key way to increase efficiency and productivity. And what are some of the ways that you can do this? One is to work overtime on that bottleneck. So keep that one machine running a few extra hours a day in order to increase your profits. Or find another way to get that process done. Find a company that can do the stitching for you to work your way around the bottleneck. Or buy another machine so that this is no longer a bottleneck. If it's a matter of labor, then find more workers who can work on this machine and increase your capacity through the machine. And really focus your business process improvement on that bottleneck, because that's what's holding your whole business back. And if there are defective units coming through there, don't let them happen. So in a production process, and this doesn't just apply to production process, it applies to service businesses too, you really want to focus on what your bottleneck is, understand it, and see what you can do to increase the capacity that's going to work its way through that bottleneck. Learning Objective 7, prepare an analysis showing whether joint products should be sold at the split-off point or processed further. And the idea here is that sometimes there's a single raw material input that's going to create several end products. For example, if you think about animals, meat, and if you slaughter a cow, there are lots of different products that you can produce with that one cow. First of all, there are all these different cuts of meat that are used for different purposes, but then there are other byproducts of the cattle that are used to do all sorts of things. So, for example, you would make leather out of cattle, and there are all sorts of other derivatives that come from it. So they really try to set it up so that very little of the carcass of the animal is wasted. They use everything they possibly can, and that would be an example of a joint cost, because what you would do is you would slaughter the animal, and then the animal would, the butcher would cut the animal into all sorts of different sellable products. So you're going to remember that analogy. I know you're going to remember that example. That's an example to bring home with you. Anyway, the number of end products, there are a huge number of different possible end products. Another one I've talked about, oil and gas before. Crude oil is actually used to make more than just gasoline. It's also used to make all kinds of plastic and other chemicals. So these are called joint products. When you make two or more products from a single thing, they're called joint products. So all the different cuts of meat, leather, all the other things you make from that cow, they're called joint products. And the point where they split off is called, in other words, the point where you would start off with one raw material and then you would get lots and lots of joint products, is called the split off point. So here, this one here is talking about crude oil, and you have just crude oil, and that would be split off into oil, gasoline, all different kinds of chemicals, asphalt, plastic, all kinds of different things. And where that's done, which would be in an oil refinery, is called the split off point. And then these different products are going to be sold. Some of them might be processed further. So, for example, you might take what you need from the crude oil to make certain chemicals and then process them further so they can be sold. Other things can come right out of the process, can be split off and sold immediately. And this is very difficult, because what you have to do then is you have to take the cost of the raw material and allocate it to all the different joint products that you're making. So you have to take the cost of that one cow and allocate it to all the different cuts of meat and all the other different products that you're planning to sell from it. And you're going to use something, usually you use what's called a relative sales value method. In other words, you try to figure out what the relative sales value of each product is, and then you allocate the cost in the same way. So for example, if you have a single product, single raw material that's going to be split off into two products, one product is worth 2/3 and more, one product is worth twice as much as the other, then that more valuable product, A, will get 2/3 of the cost, and the less valuable product is going to get 1/3 of the cost. And these allocations can be very confusing because they can lead to a lot of bad decisions, and you got to be extremely careful about that. And when you're making decisions about what to do from the split off point, you usually ignore the joint costs themselves. In other words, you might allocate joint costs for accounting purposes to prepare financial statements, but you're not going to allocate joint costs when you're making decisions to process further. Now, let me explain what I mean by decisions to process further, and then I'm going to give you a big example, as I always do. What you have your split off point, and then you have another raw material that comes from the original product. And let's say, again, we're dealing with a cow. So the split off point is a raw hide. And you need to decide, should I sell the raw hide as is, or should I process the raw hide into leather? I could sell the raw hide for a certain amount of money. That's just the skin. Or, for an additional cost, I can tan that raw hide into leather. What should I do? Well, one thing that's irrelevant to that decision is the joint cost. In other words, how much it cost for the original cow that got, kind of split off into the individual parts. So the real original cost of that raw hide came from the cost of the cow, was allocated from the cost of the cow. And now your decision is, should I process it further? Should I sell it as a raw hide? Or should I sell it as the completed product, leather? And the original cost, the joint cost, is not going to be relevant to that decision because you had it one way or the other. The raw hide cost a certain amount of money. And whether you process it further into leather or you just sell it as raw hide, the original cost of the leather that was part of a joint cost is just irrelevant. And then what you want to do is you want to see what the incremental revenue is from further processing versus the incremental cost. So if you're looking at leather versus raw hide, you would ask yourself, how much more can I sell the leather for than the raw hide? And how much more is it going to cost me to process the leather out of the raw hide? And you would look at those incremental costs. So we have here the Santa Maria Wool Cooperative out of the book. And we have wool. And then there's a separation process for the wool. And there's a certain amount of wool that's created, I guess from sheep. And then it goes through a separation process where the wool is split off into 3 different products. What's called coarse wool, fine wool, and super fine wool. And at this point, the sales value of the undyed wool would be $120,000. Undyed coarse wool would be $120,000. For fine wool would be $150,000, and for super fine wool would be $60,000. So each one could be dyed, and that would increase the sales price like so. So the question is, should you dye it, or should you leave it undyed and sell it as your intermediate product? So first, let's figure out how much income Santa Maria Wool earns, assuming that they do everything. So I have here the combined final sales value would be equal to 160 plus 240 plus 90. Or $490,000. And then you have the cost of producing the end product. So you have the cost of the wool. And that's going to be, if we go back here, you'll see it was $200,000. Then we have the cost of separating the wool, which is $40,000. And then we also have the combined cost of dyeing. And that would be 50 plus 60 plus 10, or 120,000. So those are all the costs that they incur. And the total cost would be $360,000. So their net operating income, assuming they continue to process everything, is going to be equal to 490 minus 360, or $130,000. And I'll just format this. Now, the question is, should we leave these alone? This is our net operating income if we do everything. The question is, should I leave these alone and sell them as intermediate products, or should I do this additional dyeing and sell them as end products? That is the question. So let's figure out how much is earned from each product by further processing the product. So the final sales value for coarse wool is 160,000. For fine wool, it's 240,000. It's right at the top of the screen. And super fine wool is $90,000. But the sales value at the split off point for coarse wool is 120. For fine wool, it's 150,000, and for super fine wool, it's $60,000. So that would give you incremental revenue from further processing for coarse wool of 160,000 minus 120, or 40,000. For fine wool, 90,000, and for super fine wool, 30,000. So that's how much additional revenue we would earn. Now let's focus on the cost of the further processing. The incremental cost of further processing is also given to us in the problem right here. It's the cost of dyeing. It's 50,000, 60,000, and 110. So if you subtract the incremental cost from the incremental revenue, you get profit or loss from further processing. For coarse wool, it's $10,000 less profit. For fine wool, it's $30,000. And for super fine wool, it's $20,000. So the answer here is that if you wanted to increase your profit, what you would do is sell coarse wool at this split off point and continue to dye fine wool and super fine wool. So what your product mix here would be to max, and you could increase your profit $10,000 from $130,000 to $140,000 if you do this. So what you would be doing basically in this diagram is you'd be selling the undyed coarse wool, and then dyed fine wool, and dyed super fine wool. We talked previously about activity-based costing, and I just want to tie that into this conversation here to tell you that ABC costing is very helpful for this process because it helps you identify what costs are relevant to a specific decision. If you have the better your understanding of your cost behavior, the better you'll know whether a cost item or even a revenue item is relevant to the decision that you're making. And this is especially important when you're dealing with service businesses and selling and administrative expenses, because traditional cost accounting tends to emphasize manufacturing costs, whereas activity-based costing is much more flexible and inclusive in that it also talks about selling and administrative costs. And the more you know about how your costs behave, the more information you have to make a good decision here, because things can go wrong. And a lot of times you may think something is relevant, but it's not, or you may think it's not relevant, and it is. And that can cause you to make all kinds of mistakes, and the mistakes may potentially cost a lot of money. So the situation with traceability is also a case where you're just told that something is a traceable cost, and it actually isn't. And you have to be very careful to make sure that the relevant costs are really avoidable costs or not. And if you go through our MBA program, I do some cases with this type of decision making in the MBA class, and we talk more about how different pitfalls when you're going through this process and what could go wrong and how to avoid that. So that's chapter 7. Thank you for watching. If you like the video, click like in the box below, and maybe I'll see you for chapter 8.